Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 31st of August. I'm Daniel Lam, your host for the podcast. Now, yesterday we spoke about the steady uptrend in the US dollar. Actually, there was another prominent uptrend in the form of US 10-year Treasury yields. Rising from 3.3% in the middle of May, it went to a peak of 4.3% 3 months after. However, recently, there has been some pullback. So this has prompted quite a bit of discussion at client meetings. Is this the right time to add to US longer-dated treasuries? So in our view, US and DM IG government bonds, they do offer an attractive risk-reward. We assign a high probability to a decline in yields over the next 3 and 12-month horizons. So the rise in yields in the summer was due to a combination of expectations of slower pace of rate cuts by the Fed next year, increased bond supply pressures, and investor positioning for a hawkish message from Fed President Powell at the Jackson Hole Conference, which he did. However, US data has been slowing down recently. So for example, the PMI data, indications of easing labor demand, as well as the larger than expected drop in US consumer confidence this week. So those are reigniting investors' focus on the timing and magnitude of Fed rate cuts. Moreover, we believe the rise in yields have been excessive compared to the Fed fund rate. So let me explain a bit further. Ever since the Fed started hiking rates in 2022, the 10-year US government bond yield has been closely correlated with the expected Fed fund rate in 12 months' time. However, with the Fed fund rate expectations staying largely stable over the past few weeks, the rise in yields indicates a disconnect with fundamentals. Indeed, the speculative short positioning is elevated, and this, combined with increased supply pressures, appears to have led to a temporary rise in yields. Now, technically, the risk-reward does look favorable, with 4.5% a key level of resistance for the US 10-year Treasury yield. Our expectation is for the yields to drop to 3.25% over the next 12 months. And there is a chance that it may drop by a median of 260 bips over 22 months, which was historically seen around recessions since the 1950s. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.